subscribe now and press the bell icon. Never miss an update.
Unit 10, and this chapter is going to be focused on related party sales. What are related party? How are the gains on sales to related party treated? How are the losses treated? And that is going to be the first section. Second section, we are going to focus on section 1231, 1245, 1250. Those sections are related to sale of business assets. Whenever we are talking about sale of business asset, we immediately, it should, some bell should ring in our mind that, oh, this is a business asset. This is definitely going to have some different treatment than a regular sale of a personal asset. Because there's something called recapture, meaning all the ordinary, like whatever deductions have been taken up earlier will need to come back as income again. Okay, so we'll go over that. Like right now, we don't need to focus on that. What we're going to do is we'll probably just finish up related party sales. If we have time, how big is that? Yeah, if we have time, we'll start with business property. Otherwise, we'll just finish up related party today. So, okay, this study unit involves discussion of related parties, sale of business property, and installment sales. That's the third part of this unit, installment sales. So, if the entire sale amount is not coming in one shot and if it's spread over different tax years, then how do we take gains on that? Or losses, whatever that is. Sorry. So there are some special rules that prevent taxpayer from receiving unwarranted tax benefits. People should not receive any unwarranted tax benefits, meaning any unfair tax benefits and all. So that's why those rules have been created. Losses, and there is again, whenever related parties are involved, what are related parties? We'll see it in a bit. But whenever related parties are involved, there is a good amount of chance that the transaction may be biased, or it may not have been done at arm's length, or it may have been initiated with an ultimate goal of evading some taxes. So there are certain rules whenever it is related party, and we need to follow that. And those rules are a bit harsh, but that's what it is. Losses on sales to related parties are disallowed. That's completely disallowed. Any loss on sale to related party, except for sales and corporate liquidation rules. If the corporate is liquidating itself, the company is shutting down, then it's a different thing. Shareholder may be a related party. That's why they're talking about corporate liquidation. And shareholder may get money back in liquidation. Depreciation is recaptured on the sale of business property. Depreciation which have been taken as a deduction earlier, it needs to be recaptured. Recaptured meaning we are again going to capture it for the purpose of taxes. We're going to capture it and put it on our form, 1040 or 1120 or whatever, and make sure this is coming up as taxable recapture. So depreciation is recaptured on the sale of business property in order to prevent taxpayers from taking ordinary depreciation deductions and then receiving capital gain treatment at the time of sale of property. So when we are taking depreciation deduction, it's always an ordinary deduction. Whenever we are claiming depreciation on the business property, what it does is it will reduce your ordinary income. So we get a benefit of that by reducing our ordinary income, and that's why our taxes will also get reduced. But when we are selling that off, what IRS says is that, hey, wait a minute, you have already taken a deduction for depreciation. Last 5 years you have been depreciating this asset. Every year you're taking deduction. Every year we are giving you benefit. You're able to reduce your income. You're able to reduce your liability. But now when you're selling it, we don't want you to just capture everything as long-term capital gain. All that benefit that you have received, make sure you are giving it back. By how? By taking that ordinary depreciation deduction as, like, by taking that depreciation deduction as ordinary income, and then what is left will be given capital gain treatment. By doing that, what happens is whatever depreciation has been taken earlier, that comes back on ordinary tax rate, which could be 30%. But the long-term capital gain may come, on your tax return as a 20% tax rate income. So there is a difference. IRS will get more money, by this way. So when payments from this is installment thing. When payments from sale of property are received after the year of sale, gain recognition is deferred for each payment until the payment's corresponding tax year. Okay, this line is talking about installment sales, so we'll focus on that later. Let's look into related party sales. So what they're saying is there are certain rules that will limit the taxes. First rule is gain recognized on sale of an asset is ordinary income. When an asset is transferred to a related person in whose hands the asset is depreciable. Whenever this kind of transaction is happening between two related parties, that we are selling an asset, okay, one related party is selling it to the other related party. And if the other person is buying that with the intention of depreciating it in future, or in the hands of the buyers, if the asset is depreciable, then what IRS is saying is any gain on sale of that asset will be ordinary income. That means wherever you see ordinary income, immediately it should strike us that this is going to come up at the highest tax rate possible. We are not getting advantage of long-term capital gain. So do the planning. Whenever you're planning to sell something to a related party or buying it from a related party, we need to understand how it works. Okay, so the gain, typically this all gain on the sale of an asset would be considered as the capital gain. If it's long-term capital gain, it needs to be taxed at a lower rate. But if it's short-term, it doesn't matter. Short-term will come at ordinary rate only. But here what they're saying, it doesn't matter whether it's long-term, short-term, we don't care about that. As long as the transaction is happening between related party, there's a good chance that you are the controlling person. Both the parties are controlling the people, and they may be able to control the transaction in a way which is tax beneficial for them. So IRS wants to avoid any of that. In order to discourage that, what they're saying is, fine, you want to go ahead and sell it to related party, go ahead. We'll just make sure we are taxing you that income at ordinary rate. Okay, so for this unique situation, what does related mean? Any person with the controlling entities. If the person is a shareholder in one company and that company owns another company, right? The shareholder of the parent company may have a controlling interest in the subsidiary company. Or the way it is structured and all, if the person is a director or a majority shareholder and all, that person may have a controlling interest. So that person will be related. Why? Whenever they are having controlling interest, they can modify the transaction. Any taxpayer and a taxpayer and any trust, any transaction doing with the trust where either the taxpayer or the spouse is a beneficiary. The trust may have its own identity. The trust is filing its own return. That's fine. But if we are doing a transaction, like I have a property, I have a house, and I made a trust for my own benefit or for the benefit of my spouse, and then I'm saying, okay, I want to sell this house to the trust, for whatever, $500,000, $1 million. This will become a related party transaction. So any gains that I may have by selling that, I may think that, oh yeah, I will sell it at a higher price and maybe get some gains or do something and all. But what they're saying is all that gain will come up as ordinary income. Any executor and beneficiary of a state is, I mean, there is, whenever there is an state, we know executor meaning the person who has rights to make the decision, to distribute the property, to, to manage the asset of the state and all those things. Beneficiary meaning just the person who gets some benefit from that. The beneficiary may not have any executor kind of rights there. Obviously, they'll not, because these two are different positions given in the trust. Employer and a welfare benefit unit. If there is an employer and then there is some they're putting a fund directly, or which is being controlled by the employer, that may be some benefit fund for the employees or for something. But imagine if that money grows in there and becomes like $5 million or something, and then employer wants to take it out. It's a benefit fund. It has some rules how it needs to be used, but they may want to do some transaction with that fund, so that will be considered as related party. There will be more there could be more examples, not just this, but they're just giving few incidents here. So what we have seen is the gain will come up at an ordinary income and the loss will be completely unrecognized. So loss realized on sale or exchange of property is not recognized. Again, we are being like beaten from both the ends. First of all, if there is a gain, gain, obviously put it up for tax. Not just capital gain, ordinary tax we want. Loss, oh, you are having a loss with a related party, fine, that's not allowed, completely not allowed. Is not recognized, and there is the transferee takes a cost basis, whatever. There is no adding of holding periods. We have seen that HP holding periods, like when the property is transferred through gift or inheritance, then the old holding period also gets transferred and all. But here they are not giving that advantage. So that means whenever you are transferring the property, the clock gets reset. From that day, now you again count the number of days or months or years you belong holding the property. So first 1 year, it will again be a short term, then it will become long term. Gain, this is an important point, gain realized on a subsequent sale. Okay, so what happens if a property is, let's say there's one person A, there's another person B. Okay, both of them are related parties. A sells something to B at a loss, but loss is not allowed for A to claim. Fine. B takes it up. B sells the property to C, and C is not a related party. This is what they are saying. When B sells it to C, if there are any gains on a subsequent sale to an unrelated party, it is recognized only to the extent it exceeds the previously disallowed loss. So here IRS is being fair a bit. What they're saying is that, okay, earlier when the transaction happened between A and B, we did not allow you to take the losses. But now when the transaction is happening between B and C, and you are having a gain, okay, then you can reduce your gain by the losses which were disallowed earlier. Okay, we'll go over this example, then it will make it clear. 1 minute, I'll just read this part as well. Losses realized on a subsequent sale. Okay, then they're again talking about subsequent sale to a third party. It's not a related party. So here we saw if there are any gains realized on subsequent sale. Now they're saying if there is a loss realized on a subsequent sale, it is recognized, but the previously disallowed loss is not added to it, because it is happening from B to C, which is unrelated party, which is non-related, which is a third party. You can take the losses, you can claim the losses, but whatever you had to forego between A and B, some transaction took place and A was not able to claim the loss, that loss is gone forever. I think it's fine, it's gone, we cannot let you take that loss as well. But if you are having a profit, then we'll allow you to reduce your profit with that old loss. Okay, so let's go over this example. Maybe then it will make it a bit clear. Tanya, you want to read it out?
Disallowed loss on sale to related person. Taxpayer A sells stock with a basis of 100,000 to a related person. Taxpayer B for 80,000, creating a 20,000 disallowed loss for taxpayer A. If taxpayer B in turn sells the stock to an
So let's
unrelated
let's
party,
write down this number. Let's write down this number. A is having a basis of $100,000 in certain asset. A is selling it to B for $80,000, and B is a related party. Okay, write it in your notebook. B is a related party. So there is a loss of $20,000. It is disallowed. On this transaction, there is a disallowed loss. Then subsequently, what happens? Yeah, Tanya, go ahead.
if taxpayer B in turn sells the stock to an unrelated party for 130,000, creating a realized gain of 50,000. That is 130,000 minus 80,000 because his basis is 80,000.
Okay,
Taxpayer B only has to recognize 30,000 gain. That's
okay,
because his realized gain is 50,000 and 20,000 disallowed from the original transaction.
right,
In addition, if the unrelated sale had been only 90,000, in addition, if the unrelated sale had been only for 90,000, relating in 10,000 gain. So it's basically 90,000 minus 80,000, the basis of taxpayer B.
right,
Taxpayer would not recognize any gain of any gain, as the 10,000 gain is offset by 10,000 of the prior 20,000.
right. So here what we are doing is gain is only 10,000, but there is a disallowed loss of 20,000. So the taxpayer says, well, I have a gain, fine, but is a disallowed loss. So I'm going to reduce my gain with that loss, which was disallowed earlier. So it becomes zero. It becomes zero. It doesn't mean that they're able to take 10,000 extra loss. No, just the gain is reduced to zero. Okay, this 10,000 minus 20,000 doesn't become minus 10,000. We cannot say that, okay, I'll now claim a loss of $10,000. No, 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 that is not allowed. What I is saying is, we just make sure, at the most, we can allow you to make your gain as zero. So we cannot allow you to take that remaining loss, as a carry forward loss, or you apply it to some other income. Okay, let's read from here finally.
Finally, if the unrelated sale had been only 65,000, creating an additional 15,000 loss, taxpayer B could only recognize 15,000 loss and not 35,000. That 20,000 was never allowed, so he can't recognize that anyways. Only the 15,000 loss from the current transaction can be recognized.
Why 15,000, Tanya? How did we come up to 15,000? How did we come up to 15,000? Or anybody else can answer that.
80,000 minus 65?
Perfect. Yeah. No, some of the questions will be very straightforward, so don't get confused if I'm asking, because it is not mentioned here. So the 15,000 loss will come because B has paid 80,000. Now B is selling it for 65. Sorry, here 65. So 15,000 loss. But IRS is not going to be that, kind enough or generous enough to tell you that, oh, well, you have a loss 15,000, don't worry, make it 35,000. Take that extra 20 also. No, they will limit it there. I said, okay, yeah, that looks like a real loss, right? Because this is between unrelated parties. So fine, go ahead and take that loss and offset it with some other income. Okay, but that remaining 20,000 will not be allowed. Okay, are we clear on that? What we need to remember here is any loss on a related party transaction is not allowed. Any gain on a related party transaction will come up as, who can tell me that? Sakshi, it will come up as what kind of income?
Ordinary income, ma'am.
Yeah, will come up as ordinary income. So those things we are clear. But now what we are saying is, okay, fine, this transaction is over. What happens subsequently if the person sells it to an unrelated party? Then how should we adjust our basis? What should we do with our other losses which were never allowed? So this is what IRS has given these kind of rules. Any questions? Is that clear, honey?
Ma'am, I'm having one doubt.
Huh?
Yes, ma'am.
In first para, last line, the 10,000 gain was offset from the previous loss 20,000.
Mm-hmm.
So it will be remaining 10,000 loss, no ma'am. Previous loss. So that will
Yes.
be carry forward.
No, I just said that. Only your gain will become zero. I mentioned that. The IRS is saying just make your gain as zero, but we will not allow you to carry it forward. Okay, all we are doing is taxpayer is not recognizing any gain, but it is not giving it a benefit of carrying it forward and all those things. Okay, what it's saying is only to the extent there is a gain, you can use your disallowed losses and reduce it. But it's not saying that you can carry forward the remaining losses.
Okay.
Okay. All right. Then let's look into the next point. What they're saying is if there has been a transaction between a party which is tax indifferent party. Now, what does that mean? That means that that party is not paying any taxes in US. Okay, that maybe they are not US people, or maybe there is some treaty, or maybe they are like a tax exempt organization, government entities, so they don't have to pay any taxes. Okay, let's look into this again. For property purchased on after whatever, a new rule precludes the previously discussed recognition of the disallowed loss. Okay. Um, if the original transferor is a tax indifferent party, so what they're saying is, like, if there is a transaction between A and B and A is tax indifferent, meaning it doesn't matter whether there is going to be taxable transaction, non-taxable, because maybe it's an exempt organization, maybe it's a charitable organization, they are not paying taxes anyways. Okay, then in that case, how would the treatment take place? So what they're saying is tax indifferent parties are those not subject to fine. That is okay. Um, so the new rule precludes the previously discussed recognition of disallowed loss. Okay, maybe the what it is saying is that original loss will not be you'll not be taking advantage of that disallowed losses. Why? Because it's not like party A here. It's not like party A is really suffering because their losses were disallowed. No, it doesn't matter to them. Anyways, they're not paying taxes. They're not going through any tax hardship. They're not being put up on disadvantageous situation. Like here, A is selling to B for 80,000. 20,000 he's making loss, but A is not able to claim that loss. This is a clear disadvantageous situation for A. But if A is a tax indifferent party, meaning A is anyways not paying any taxes, it doesn't matter to A. He's saying, fine, I don't care even if I make $1 million, if I make losses, anyways, whatever I'm doing is completely tax exempt. Then in that case, IRS doesn't want to give benefit to B, saying that okay, later on when you sell your property at a gain, you can take advantage of this loss. IRS saying it doesn't matter to A. It's not like he lost anything. It's not like he had to incur extra tax liability because of our disallowance. Nobody's going through any hardship. Why should we give you an advantage? Let's read this example. Honey, can you read 10.2?
Yes, sir. Returning to example 10,
Point one, if taxpayer A is changed to a tax indifferent party, the disallowed loss is still $20,000 when the stock is sold for $80,000 to taxpayer B. However, on the sale from taxpayer B to an unrelated party for $130,000, the realized and recognized gain is $50,000. That is that $130,000 less $80,000. The $50,000 gain is not offset by disallowed loss.
Right. Here, IRS is not giving that advantage. Right. Here, IRS had been bit generous. They said, well, you are having a gain of 50,000 now. Don't worry, because earlier we disallowed that. Now you can take advantage of it. Reduce your gains to 30,000. Because somebody was genuinely deprived of claiming those losses. Here, taxpayer A was not allowed. He was like, maybe it's a genuine transaction, but it just happened between related parties. Maybe it happened at the fair market value, at the reasonable value. Still, because it's related party, IRS said, well, not allowed. So taxpayer A was in a detrimental situation that time. But when taxpayer A is tax indifferent party, it doesn't matter to taxpayer A whether you allow or not allow, because they don't have to pay any taxes. Then in that case, IRS is saying, well, yeah, why should we give advantage? No, you just make sure the entire 50,000 has been put upon for taxes. Let's see what are related parties under Section 267 and all. They are saying that any ancestors, lineal descendants, spouses, siblings, and all, they're all considered to be related parties, not nephews and nieces. Any trust and beneficiary, any controlled entities, any constructive ownership rules also between family members. They may say that something, there are a lot of family members and all, then the small ownership can be given to all, saying that one person doesn't control. But that doesn't mean we'll have to look into the constructive ownership rule. If what is the ultimately what is going on, can they combine all these things and still say that okay, these people have control and all between the immediate family members? If yes, then it could be considered as related party. Any loss on sale of exchange of property between a partnership and person owing more than 50% is not recognized. Okay, if any partner is there or a shareholder who owns more than 50% of the capital, and that person is doing some transaction with the partnership, then this is not, any loss is not deductible, and gain will come up at ordinary rate. No loss is deductible. Okay, any employer-employee transaction, well, employer and employee are not considered to be related party, because a lot of times employer will give away something to employee at a lower than FMV, or maybe for free, but then that could be considered as perks. It may be taxable in the hands of employees, or the employer may give certain assets to employees at less than fair market value. But at that point of time, we have to see what is the difference between fair market value and at what price employees buying that. That gets added as compensation, and employees paying taxes on that. Okay, so they are not considered as related party for this, these rules. Interspousal transfer. Okay, any transfers happening between husband and wife, they are not considered to be related party transactions, because no gain or loss is recognized on the transfer of property between spouses, or anything related to divorce or some other arrangement that may have. This is not, it's not a taxable transaction, it's not a tax deductible transaction. And these rules will also apply when the transfer is a gift, sale, and exchange. So yeah, like few days back, there's somebody, a client of ours, called up, and this guy is going through some divorce and all. So he was quite determined that, look, wait, see, I'm losing my house to my wife. I have really put in so much of money. I should be able to take a deduction for that. And those kind of inquiries are very common. They may come and say, well, this is because of the court order, I have to give it away, whatever, all this. So I should be, at least this is a loss for me, at least I should be able to claim something. but there is a clear rule that this is between husband and wife. If you are losing it, you want to claim losses, then she should be claiming gains, right, and paying taxes on it. It doesn't work like that. So what IRS has said is, and this is very common, right? Transferring of property for whatever reasons. Either they want to give each other a gift, or because of the separation, they want to split up the property, whatever. So that is not considered to be a taxable transaction. So we'll just stop here now.